Let's talk about one of the biggest, strangest puzzles in finance. I call it the persistence paradox. It's this weird situation where, the stock market has proven to be the single greatest wealth-generating machine in history, and yet most people who actually invest in it, well, they just don't capture its returns. So that really gets us to the heart of the matter for this whole explainer. Why on earth are we as human beings so consistently bad at investing our own money? When you look at the data, it's pretty clear, and honestly, it's kind of shocking. Just look at this. Let's say you put $100,000 into a simple S&P 500 index fund and just left it alone for 20 years. That money would have grown to over $700,000. Not bad, right? But the average investor? Their fund ended up with just about $345,000. I mean, that's less than half. And this huge gap, it's not because they picked bad stocks or paid high fees. No, it's all about behavior. And don't think for a second this is just some old historical problem. This is happening right now. The data from just last year is fascinating. The market had a fantastic year, returning a solid 25%. But the average investor? They only managed to capture about 16.5% of that. They left a staggering 8.5% on the table in a single year. So what in the world is going on? Well, it turns out our biggest enemy might just be staring back at us in the mirror. Okay, so the first piece of this puzzle is actually inside our own heads. We're going to take a look at your brain on volatility and really see why our own instincts can be the enemy within. So it all boils down to this one crucial concept: loss aversion. It's a fundamental part of our wiring. The pain you feel from losing $100 is psychologically about twice as powerful as the joy you feel from gaining that same $100. And that one simple fact, man, it explains so much. Our brains are hardwired to avoid loss at all costs, even when it makes zero rational sense. This quote just hits the nail on the head. The market doesn't just go up in a nice, neat line. Of course not. It moves in these cycles of gradual and then sudden. You get these long periods of calm and then, bam, a violent, sudden drop. And it's those sudden drops that are perfectly designed to trigger our deep-seated loss aversion and test our patience to the absolute limit. Think of it like a battle raging inside your skull. In one corner, you've got the amygdala, your ancient primal fight-or-flight response. It sees a market crash and it just screams, "Danger, get out now!" That's what leads to panic selling. And in the other corner is your prefrontal cortex, the logical, modern part of your brain that knows the plan is to buy and hold. But when volatility hits, that amygdala just hijacks the whole system. But here's the thing. It's not just our internal wiring that's messing us up. The outside world has built what I like to call the noise machine, and it takes all our worst instincts and just pours gasoline all over them. It's the perfect storm for making really, really bad decisions. I mean, think about the 24-hour financial news cycle. It's literally designed to grab your attention. And how does it do that? By weaponizing your fear and greed. Every little dip is framed as a market in turmoil, and every rise is a surge. This creates this constant false sense of urgency, making you feel like you have to do something. And that just pushes everyone into herd behavior. We sell when everyone else is panicking, and we buy when everyone else is euphoric. It's a complete recipe for disaster. And to be fair, the fear is totally understandable. I mean, look at this timeline. Brutal market crashes are not a bug. They're a recurring feature of investing. We've all lived through some of these massive drops. But the key pattern here isn't just the crash itself. It's that after every single one of these events, the market has always, eventually, recovered and gone on to reach new highs. The media just loves to focus on the pain, not the resilience. All right, let's move on to our third driver. And this one's a big one, because even if you can master your own brain and tune out the media, there's another huge problem. Life just gets in the way. These are the cracks in our financial foundation. This number right here is just staggering. Over a third of Americans don't have enough cash saved to cover a simple $400 emergency. Think about that. So if your car breaks down at the same time your investments are down 20%, you don't really have a choice, do you? You're forced to sell at the absolute worst possible moment, locking in those losses for good. And just look at the mental toll this takes. People without an emergency fund spend over 7 hours a week stressed out about money. That's almost a full workday, every single week, just spent worrying. That kind of chronic stress just drains your mental energy, which makes you even more likely to make a bad, fear-based decision with your investments. See, financial stability and investment discipline are completely linked. Okay, so we've laid out the problems. Our brains, the media, and our own financial fragility. It sounds kind of bleak, right? But it's not. So how do we fix it? Let's get to the solution. I call it the persistence playbook, and it's a pretty simple three-part plan to get you on the right track. Here it is. It's 3 levels of intervention. First up, the structural level. You have to build an emergency fund. This is your shield. It's what protects you from ever becoming a forced seller. Second, the cognitive level. You need to build real financial literacy. Understand why the market behaves the way it does so you're not so easily spooked by all the noise. And third, the behavioral level. Automate everything. Just set up automatic contributions to your investments and let it run. This way, you bypass your emotional brain entirely and just execute the plan. So I'll leave you with this one final thought. We know for a fact that the market's journey is and always will be volatile. That's a given. The real question isn't whether you can predict the next downturn. The question is, are you building the right scaffolding, the structural, the cognitive, and the behavioral scaffolding to survive it? Because when it comes to investing, persistence isn't just an important thing, it's everything.